Joining me today is Frank Holmes, CEO of U.S. Global Investors. And Frank, you've been talking about a possible correction for quite a while. Tell us why what we saw this week was normal, in your opinion.
You know, we love to go back and look at history, and we say that two things we follow. In all our perspectives, we say we believe that government policies are a precursor to change, and that we create statistical models, macro and micro models, to try to understand the volatility of markets and trends. So we are in a secular bull market, and we've been in that market for over 18 months, and it started in January of 2019 when the 50-day average price of gold went above the 200-day. And so far, we've had several of these corrections in this run to 2000, and it's just normal. And then I went back recently to the research of 2008 when gold bottomed, to 2011 when I went to 1900. And there we had these huge corrections of 3 times of more than 10%. Now, the DNA of volatility of gold stocks is 2 to 1. That is, gold falls 10%, the gold stocks will fall 20%. Gold goes up 10%, gold stocks go up 20%. And it's just recognizing and respecting that DNA of volatility. And every asset class has its own DNA of volatility. And what I love, because the CNBC interviewers so often in New York are, anti-gold, and they just don't get it, but they say it's too volatile. But gold's volatility on a daily basis, 70% of the time, it's a non-event, David, to go up or down 1%. And over 10 trading days, it's a non-event to go plus or minus 3%. Gold and the S&P 500 are the same. They actually have the same DNA of volatility. It's the gold stocks which have a greater volatility, like silver has a greater volatility to gold. And when you map this DNA of volatility of how much has moved over 10 days or 60 trading days or 1 year, it gives you a feeling to sort of counterweight your emotions of greed to fear.
You're right, Frank. What we saw on Tuesday, however, was the biggest one-day drop since 2013. Was the magnitude of this drop concerning to you?
No, because we made all-time highs.
Okay,
That's what you have to expect.
So the higher the price, the more positive the rally, the more momentum we're seeing in the bull market, the more corrections you can expect. Is that more or less your thesis?
The velocity of new entrants and people taking profits that were earlier increases. So that volatility increases. And that's what usually takes place. But what I was trying to point out to investors is that gold over 60 trading days was up 2 standard deviations. Well, that suggests over the next 60 trading days, a 90-some-odd% probability of a correction. And what would that correction be? Well, 1% is 1 sigma over 60 days is about 6%. So that means if it was to revert back to the mean, you get a 12% correction. That doesn't mean it's a bear market, not even close to it.
Do you think that any macro conditions were responsible for this week's correction, or was it just technical correcting, as you said?
Technical correcting, the dollar got a little stronger, that impacted. But you know what really blows me away is the euro. I mean, the euro should be at 85 cents to the dollar for so many other fundamental factors I look at. But right now, on macro forces, is more sentiment. And I think that when we go to this next wave up in gold to even higher highs, we're going to see all of a sudden gold marching up in many more countries' currencies relative to the dollar.
Do you think that there would be any activities that central banks around the world outside the United States could take that could drive up the dollar?
Rates, real interest rates on a relative basis.
Yeah,
if they popped interest rates, the Fed funds to 1%, gold would crack in dollar terms, and the dollar would soar against other countries' currencies. Gold would stay on a relative basis high in euros and yen, etc., because their rates are still nothing. So it's really it's an interest rate differential.
Right.
But what's important for investors is to recognize that most of the negative real rates still to this day are in European countries, and most of the world, the G20, are at flat interest rates or zero. And this really makes gold this an incredibly attractive asset class.
Yeah, so you made a good point on the interest rate differentials. If everybody eventually hits a negative real interest rate environment, the differential is actually quite small. And so what's going to be driving the dollar in that case?
Well, in the super cycle, you're going to see that gold's going to go up against all these currencies, and it's going to be like watching going to the racetrack, to the Kentucky Derby, and there's going to be a whole fleet of horses like you're going to have of currencies, and number one will be gold.
Okay. You were also talking to me offline about the similarities and differences of this rally this year in gold versus 2011, particularly within the type of investors who have been crowding up or driving up the prices. So this year we saw a lot more millennial interest. We saw a lot of more speculation from day traders, whereas 2011, that wasn't the case, like you said. Can you explain this difference?
Well, the bigger part was COVID. You know, COVID basically did the lockdown, and you had all these millennials, smart young people like yourself, stuck at home. And what are you going to do? And you love to travel. So one of the big parts is they knew everything on how to get the cheapest air flights, the cheapest hotels, the experiencing world. They couldn't do that. So the data now shows that 70% of their checks went into the stock market. They themselves became speculators. Most of their sources of information was from YouTube and from podcasts. They are more sophisticated than the last big wave of the 90s when you had mutual funds. We never had any of that in 2011 gold run. That was predominantly older people. There were gold bugs. And today we have a whole new audience. And what's really refreshing is looking at Robinhood, because in their toolbar, they have gold as an asset class. They also have cryptos. So not only did we see gold go through 2,000, we saw Ethereum go through 400. We saw all these other alternative asset classes do the surge. Gold corrected, and so did the cryptos. So it's, to me, these are the other interesting dynamics, and it's so great to see millions of new, smarter investors coming in to widen the ecosystem of the capital markets.
You know what's interesting is that these new investors, like you mentioned, they weren't trading gold like it was a safe haven asset. They were, on one hand, chasing momentum, and on the other hand, like you said, COVID has sort of forced everyone to stay home and just start trading more. And so they were playing around with different asset classes. I wonder when they get a little older and, you know, in the coming decades, and they start to familiarize themselves with gold a little more, the asset class of gold will fundamentally change its role from a safe haven asset to an alternative asset to, let's say, Bitcoin and stocks. Do you see that happening?
Absolutely. And I see that platforms like Robinhood, so they're just very different. You know, when you open an account at Robinhood, you get to push 1, 2, or 3, and they give you 1 share of a new company. And I open an accounts for all my employees to get this experience. They all bought some of our Go AU ETF and our Jets ETF to get this experience. But better part is they're all coming back 1 share of Hecla.
So here's my follow-up question, Frank, is that, you know, once people in the future start trading gold like it's Bitcoin or stocks or, you know, any of these sort of alternative assets to mainstream investment vehicles, are you going to see a lot more volatility in the gold space? We're not going to see just 1, 2, 3% moves in gold anymore. We're going to see, you know, 5, 6, 7% moves, daily moves. Is that possible?
I think fear does that. I think when you have much more fear in macro forces will create that greater volatility. I just think you're going to have more liquidity. You'll have better price discovery. Very important component of the capital markets is that arbitrage and the belief of the wisdom of crowds. So I'm very happy about that ecosystem expanding. The other thing to remember is that pro sports, there's no pro, not event really. And there are so many bettors, so many speculators going to Vegas or betting on pro sports. Well, they're shut down. They become huge options players. They become speculating in gold. So you have this new wave. And I think when sports opens up, that's probably a bigger risk of the sports bettors playing stock options, gold options, etc., them leaving to go back to their sports. Where the millennials, I don't think so. I think that they're more sophisticated, and that's what our experience and our knowledge is gathered from coming into Jets, which we've spoken before. You know, 70 days in a row during COVID, $1 billion to come in, 25,000 retail people through Robinhood. and then it took off. Why? They had a rational reason that at the bottom of these markets, airlines 6 months later can be 80 to 120% higher. So
Right.
then now we see it in gold. We're seeing them coming into junior mining, looking for that exploration, doing the research, trying to figure out how do you pick a good gold stock from a bad one. So it's a very different environment.
Frank, you've been on the show a couple of times in the last month and a half talking about your $4,000 gold call. I'll revisit that very briefly to the people who haven't seen it yet. Basically, you're saying that the next target is $4,000 based on historical precedents of what gold has done during the last expansion of the Federal Reserve balance sheet. And so, this is 2-3 years out, your projection, right? During this time,
3 years out, it's a CAGR of 20%. Because the amount of debt being printed, the deficit is up 300% today. Take a look at it. That's a classic factor. And that's up not 30%, but 300. So the thought process of gold going to 4,000 at a 20% CAGR over the next 3 years is very reasonable.
I think after what we saw this week, some gold investors might say to themselves, look, this really scared me. I don't want to be holding on to an asset for 3 years and have it drop another $100 without notice. What can you say to those people and reassure them that holding in the long term is probably the better idea, if it is?
Well, I think on my website at usfunds.com, I have a whole set of articles called Managing Expectations. And life is about managing expectations. And I love Warren Buffett when he says that to have a long-lasting marriage, have low expectations, because then everything is on the upside. And but as the humor to it, but more important is really understand the DNA of volatility will help any investor use volatility to their favor.
Mm-hmm. And you talked about the 10% golden rule, right? Can you explain what that is?
Well, it's always sort of a wise thing to have 10% bullion and gold stocks and quality gold stocks. And the GDX and GDXJ, they predominantly have just a basket of names like the S&P 500. So when one buys those ETFs, they're buying good stocks and bad stocks. So that's why I created GoAU, was to sort of high grade those factors that are high quality stocks, and every quarter kick out the ones that do something that does not protect those value factors. And I think 5% in weighting at something like that, or the royalty companies, I guess I love Wheaton Precious, Franco-Nevada, Royal Gold as a basket. I think they're just a great way to play the space. And 5% bullion. And you go to Kitco, great delivery system. I recommend it all the time to get your gold and silver through the system.
Okay. Frank, let's have a little fun here, because I know you're bullish on gold. Let me just make a bearish case for gold here, and maybe you can tell me why I'm wrong here. So as we see an economic recovery, as COVID-19 dissipates a little bit more, we're going to see less volatility in the stock markets. We're going to see a little bit less fear, less need of a safe haven asset. Potentially in the near term, we might see some deflationary pressures as people still aren't spending as much money as they used to be. That might bring also further pressure on gold. The dollar as well, if the Federal Reserve for some reason does not continue the stimulus measures on the same level that they had before in March, that might also bring up pressures on gold, because the dollar might go up as a result. What do you think of that analysis? Is there any likelihood of that happening?
I think all those suggestions, if you look at the weight of the evidence, are pretty weak. It's a very different world. We've never had, look, when Greenspan left and people complained about the balance sheet of the Fed was 6% of the GDP, and now it's 30%. If you get AOCs, politicians all of a sudden becoming mainstream, and you're talking about trillions of dollars of government printing of money. I can go on with ad nauseum, and the whole monetary theory that zero interest rates is okay because the government's in control and they'll allocate capital where they see best. Anytime that's happened in any country that's trying to play that game, history's replete with it. Gold trades substantially higher.
All right. Finally now, gold miners. we're seeing some good performance from the GDXJ in 2020. You're expecting gold miners to outperform the bullion. Tell us about the conditions that are necessary for this to happen.
Well, I don't think the GDX and GXJ are the best products with all bias positioning, because you're buying good stocks and bad stocks within that just broad index. I think people have to be more selective. If you look at a company like Franco-Nevada 10 years ago, most of the gold sell analysts were negative on royalty companies, but it's only outperformed Berkshire Hathaway 300%. It's only outperformed the GDX and GDXJ by a massive margin, massive, outperformed bullion. So I think you really had to be consumed with quality gold stocks. And when we look at the industry as a whole, 100 stocks we look at around the world, the industry itself has gone to a positive free cash flow. I just hope over the next 6 to 9 months that CEOs and boards do not do stupid things of mergers that destroy the value metrics on a per share basis. That's the risk. That's what they did in 2010 and 11. All these dumb mergers that only destroyed the value metrics, and the constituents of the GDXJ experienced a 46% dilution of revenue per share, cash flow per share, and reserves per share.
Tell us how the GoAU fund picks stocks differently.
Well, it looks for those factors that when you back test it, we spend 8,000 hours of stocks that are better. And you want to find those companies that show revenue growth last quarter over 4 quarters and cash flow last quarter over 4 quarters. You want to make sure that you're buying stocks in the top half for cash flow returns on invested capital. That shows good management, shows good deposits. And you want to, so those factors, I don't care about net present value, which most gold sell analysts like to tell me this is a cheap stock versus another. That's BS to me, because I've gone and tested that model, and you can't be a winner in picking gold stocks. The winning proposition are about 5 factors: profit margin, high cash flow returns on invested capital, momentum in revenue of last quarter over the 4 quarters, and cash flow. These are very compelling factors that show you outperform. So you can take 80 stocks, 100 stocks, and take them down to basically 25 stocks. Outside of that are royalty companies, and they function on just close your eyes. They look a lot more like a technology stock. High gross margins, high returns on invested capital, and high free cash flow.
Yeah.
So that's where I'd rather see investors look at.
Frank, if you were on the board of a miner, of a producer specifically, what are some of the changes that you would make that would drive up shareholder value?
Focus on the storytelling, on the factors that attract non-gold fund buyers. So when you see Franco-Nevada and Kirkland Lake show up in Investor Business Daily's newspaper, it's a growth newspaper. It's a platform for only picking growth stocks. And it doesn't, they're agnostic to the industry. They're looking for those factors I just shared with you. And so if your story is you do have revenue last quarter or 4 quarters and last year over 3 years on a per share basis, tell your story that way. Make sure you don't do an acquisition that's going to dilute the factors on a per share basis. Because you put 2 companies together and they have bigger revenue, the market doesn't care to give you performance unless it's bigger revenue per share.
Frank, I want to thank you again for coming on the show, and it's been an interesting week, so I appreciate your insights.
And remember, David, if you're not long, you're wrong, and go gold.
Remember that, folks. Remember that. I'm David Lynn of Kitco News. Thanks for watching. Stay tuned for more.